Hello, everyone. Welcome back to Financial News. I'm Ron Jankowski with Channel 4, and my co-host is Paul Munico with Ameriprise Financial. Today is April 3rd, 2023. Paul, can you give us an update? There's so much going on. I'm just going to let you roll with it.
Absolutely, I will. Thank you. I'm going to talk about the quarter-ending look at earnings estimates. And we are seeing stocks ended the first quarter with solid gains, even as corporate earnings estimates continued to fall. The S&P 500 was 3.5% higher in the month of March and 7% higher for the quarter. Now, both figures on a price-only basis and data source from FactSet. Meanwhile, consensus estimates of Q1 earnings per share dropped by $3.51 over the period to $50.74. Overall, S&P 500 companies are now expected to report a year-over-year decline in Q1 earnings per share of 6% on a sales gain of about 2%. For the most part, the expected earnings decline is a story of weaker profit margins. We do have data that shows 8 of 11 S&P 500 sectors are expected to see a decline in earnings, while sales are expected to be down in just 3 of 11 sectors. Now, since January 2nd, quarterly consensus estimates have declined for each of the next 6 quarters. In total, S&P 500 companies are now seen as posting full year 2023 EPS of $220.40, which would be about flat with 2022's reported EPS of $219.68 if achieved. At the start of the year, consensus estimates were looking for 2023 EPS of $229.47. EPS estimates for 2024 have suffered a notable decline as well, falling to $5.37 to $248.11, which would still represent a 13% year-over-year increase from the 253.48 estimated at the start of the year. Now, for Q1, consumer cyclicals, industrials, and financial sectors are expected to see the healthiest financial results, as each are expected to report both earnings and sales growth for the period. Energy sector earnings are expected to be a solid 9% higher than year-ago levels, but on a 2% decline in sales. And all the data that we've talked about has been sourced from FactSet to give you this information today.
All right, Paul, Ameriprise had sent this information to us this morning. The U.S. stock index futures are modestly lower after a strong weekly gain, with the major indices up over 3%, and you shared some of that information.
Yeah, it was a very volatile month, to say the least. It was nice to end on a positive note, and hopefully we can follow through and keep it going into April. We'll see.
Markets in Asia closed mixed, with Hong Kong flat and Shanghai up 0.7%. Europe is mixed with a midday, with energy names taking the lead. Treasury yields are slightly higher, with some curve settings, or flattening, I should say, as the 2-year crosses the 4.11%, and the 10-year is steady at 3.51%.
Yeah, I mean, there's movement going on. The market's looking for direction. It seems like when markets are mixed, they really don't know which way they want to go, so we'll have to wait and see.
Up and down every 24 hours.
Yep.
WTI crude is up over 6% on OPEC's production cuts following a 9% gain last week. Bitcoin up 1%, and gold is up 0.5% following a 5 week of gains. surprising that that has happened, but that's how gold is, though. Here are the year-to-date index returns. S&P 500 is a plus 7%. Dow Jones is a plus 0.93%. At least there's
This
a
is
plus
positive.
there.
Yep.
And NASDAQ is a rather 17%. So
So all three,
So-
at least, are in the positive so far. We got a long way to go till the end of the year, but headed in the right direction.
hopefully upward, with the exception of WTI crude. All right, stay with us. We are going to be right back with a show called Your Money, an interesting topic that Paul usually has. Stay with us. We'll be right back. And we're back. Thank you for staying with us with our show called Your Money. And Paul is going to talk about what you should know about debt ceiling debate. And it can be pretty deep.
Yeah, and I get a lot of people asking me about what's going to happen with the debt ceiling debate and where we stand with that. So I figured good topic to talk about today.
Good.
So, if you've been keeping up on the news coming out of Washington, D.C., you do know that Congress is once again grappling with the need to raise the federal government's debt ceiling limit. Now, legislation to that effect would provide the U.S. Treasury with authorization to issue new debt to help cover the costs of programs already approved by Congress. This is a typical routine that avoids the U.S. Defaulting on its loans. However, given the polarized political climate and hardened positions on both sides of the aisle, Congress so far has not negotiated an agreement to raise the debt ceiling by the summer deadline. Now, how could the issue play out, and what are the possible ramifications for the financial markets? Let's take a deeper look. So, what's happening in Washington? The need for Congress to take action and increase the debt ceiling occurs periodically. This year, similar to prior instances, it has become a political matter with differing views on how to effectively solve the problem at hand. If the debt ceiling is not raised on a timely basis, the federal government could default on its debt. This is significant as investors look upon U.S. Treasury bonds as debt securities that are backed by the full faith and credit of the United States. A default could tarnish that reputation and potentially result in the government having to pay higher interest rates to attract bond investors. At this point, the U.S. Treasury has reached its debt ceiling limit as previously authorized by Congress and is undertaking extraordinary measures to avoid a debt default. Treasury officials indicate that these measures will likely be exhausted by June of 2023. At that time, without Congress acting to raise the debt ceiling, a U.S. government default becomes a real possibility. Markets maintain a wary eye that what would a debt default mean? So in a speech on February 14th, 2023, Treasury Secretary Janet Yellen stated that in the longer term, a default would mean future investments, including public investments, would become substantially more costly. If interest rates on government bonds were forced higher, the impact could be felt across the bond market, pushing interest rates on other types of debt higher. More directly, according to Yellen, the federal government would be unable to issue payments to millions of Americans, including our military families and seniors who do rely on Social Security. Costlier borrowing could also reverberate to consumers as they obtain mortgages, car loans, and other forms of debt. Would this have a significant and extended negative effect on the economy? Well, the answer to that is not easy. That's an open question. But minimally, we should expect that the longer the debate lingers and the closer the deadline draws without resolution, we may face increased market volatility. While you don't want to overhaul your long-term financial plan based on speculation over how it will play out, you may want to consult with your advisor about how to address potential near-term ramifications that could be reflected in more volatile markets.
Paul, things are so volatile at times, and if one of the viewers had some questions, could they contact you?
Absolutely. Contact me anytime on this topic or others. My number directly is 708-226-3412.
All right, thank you, Paul, for the information, the first show, as well as the information you just shared with us. For Paul Munichel with the Ameriprise Financial Services and myself, Ron Jankowski with Channel 4, we wish you a good investment day.